Hey friends, today we're diving into our big annual video, the 2024 Global Economic Overview. I'm breaking it all down for you. How's the world economy doing as a whole this past year? What challenges did China face? What's really going on with the US economy? And what about Japan, Russia, Argentina, India, you name it? I'm going to add a little more of my own analysis to this one. What I've got for you today might feel a bit different from the typical global economy recaps you're used to. You know how some people go bam, 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 month by month, headline by headline? Here's what happened in January. Here's February. It's exciting, sure, but sometimes it's all hype and missing the bigger picture or clear logic. Then there's the super detailed, hardcore analyses where it's just chart after chart, data overload. Let's be honest, that can put you right to sleep. So my goal here is to hit that sweet spot. We'll look at data and professional insights to build a clear picture and framework, but I'll keep it human. No drowning you in overly technical jargon or excessive numbers. I'm aiming for something solid and high value here. All right, enough chit-chat. Let's dive into the 2024 Global Championship. Before 2024, the global economy wasn't exactly in a full-blown recession, but let's be honest, it was hanging by a thread. Think about it. The pandemic, the Russia-Ukraine war, skyrocketing inflation, central banks worldwide scrambling to hike interest rates. All of that triggered a cascade of crises. A global supply chain meltdown, Europe's energy crisis, the banking crisis in the US, Japan's yen crisis, the UK's debt crisis, China's real estate crisis, and Africa's food crisis. Like seriously, can you even imagine? All of this chaos packed into just a couple of years. Any one of these crises, if it happened pre-pandemic, could have been a total nuclear-level disaster. And yet here we are, wobbling and swaying, but somehow we made it through. Now, we're not going to rehash all the past drama today. That's old news. Let's focus on what's ahead. Wow, 2024, huh? When you think about it, the major political and economic events this year, yeah, they're events, but they're not exactly ticking time bombs. For example, the US presidential election, China rolling out massive stimulus measures, Japan finally raising interest rates, the Fed cutting rates. These are all just things happening, you know? Compared to the drama of the last couple of years, they're honestly pretty tame. You could even call it smooth sailing. Dutch GDP growth hit 3.2%. Inflation eased down further, but unemployment did creep up a bit. So if I had to sum up the global economy in 2024 in one word, it's resilient. Now let me tell you, analysts absolutely love this word. It just sounds so polished and sophisticated, doesn't it? Resilient. Way better than saying something boring like average or meh. It's got that subtle motivational vibe, like the economy's out here hyping itself up. Anyway, looking at the global economy in 2024, there are two big themes to keep an eye on. Elections and transitions. Elections are pretty straightforward, right? 2024 is what we'd call a global election year. At least 70 countries, covering about 49% of the world's population, held elections. Now, obviously, we're not going to go through each one. Ain't nobody got time for that. But here's the big picture. Internal divisions within governments, widening across the board. Populism, definitely on the rise. And overall, a noticeable shift to the right, except for one outlier, the UK. Let's talk examples. The ruling parties? Yeah, they didn't have a great year. Take the US. Well, we won't even get into that drama. But in the UK, after 14 years of conservative rule, the Labour Party swept in with a landslide victory. Interestingly, Labour leans more left, bigger government policies, more progressive agendas. It's like a plot twist compared to the global trend. Definitely an exception to the rule. The other big theme of 2024? Shifts. And when I say shifts, I'm talking about major policy pivots. Here's the deal. Starting in the second half of 2023, global inflation began to ease up, especially when it came to core goods. those prices pretty much returned to normal. Oil prices dropped too, which was a huge relief. The only outlier? Services inflation. You know, stuff like getting a haircut or going to the dentist, that one's still a bit sticky. It lags behind because it's more resilient to change. But with this overall cooling trend, most economies have started to ease off the brakes. Slowly but surely, they're loosening up and shifting gears. All right, let's talk about what's been going on with global central banks in 2024. Out of the 37 major central banks around the world, 27 have already kicked off their rate-cutting cycles. The plan was simple. Everyone was watching the Fed like, hey, big guy, you go first, we'll follow. But the Fed? Man, they've been dragging their feet. We thought they'd start cutting rates in spring, but nope. They kept us waiting and waiting and waiting. By the time autumn rolled around, still no rate cuts. So guess what? Other countries got tired of waiting. The UK, Canada, the Eurozone, Switzerland, they all said, forget it, we're doing this. Meanwhile, the Fed finally woke up in September and realized, oh shoot, we're late to the party. They had to play catch-up, slashing rates by a whopping 50 basis points in one go. And then there's Japan, doing the exact opposite. Instead of cutting rates, they're over there flipping the script, raising rates for the first time after 8 years of negative interest rates. Yep, big move for them. And what about China? Well, they haven't switched directions. They've been cutting rates all along. But starting in September, they really stepped it up, rolling out big moves with both monetary and fiscal policies to boost the economy. Even the tone from the central government has noticeably shifted, signaling a change in approach. So yeah, you could say this is a kind of pivot too. Overall, though, these shifts across the board are just the first steps, so everyone's playing it cautious for now. Nothing shocking or unexpected has happened so far. All right, now let's zoom in on how individual economies are doing. First up, let's talk about the U.S. In 2024, the U.S. economy grew by 2.8%, beating market expectations for 2 years in a row. Yep, both 2023 and 2024. And honestly, out of all the developed economies, the U.S. has been the star performer. So much so that people are scratching their heads like, wait, this doesn't make sense. Think about it. Interest rates are sky high, but domestic demand? Still ridiculously strong. I mean, what's going on here? I'd call it mysteriously unstoppable. Now, why is this happening? Well, it could be that pandemic-era excess savings, people socked away a lot of cash back then, are still propping up spending. Or maybe it's the wave of people rushing to buy homes and lock in loans before the rate hikes hit. Could it be the influx of undocumented immigrants boosting the economy? Or maybe the wealth effect from a booming stock market? Or, honestly, it's probably a mix of all these factors. Bottom line, the U.S. domestic demand is just on fire for reasons nobody can fully explain. So, what was everyone worried about before? Well, J.P. Morgan loves throwing around this phrase, boiling a frog. Yeah, you know the one. Here's the idea. You put a frog in a pot of lukewarm water and start heating it up slowly. At first, the frog's like, oh, this is nice and cozy. But it doesn't realize the environment is gradually and irreversibly getting worse. By the time it's thinking, whoa, this is hot, it's already too late. Now, in this metaphor, the warm water is the high-interest rate environment. The expectation was that in 2024, something was bound to crack under the pressure. Maybe commercial real estate would take a hit. Maybe the broader economy would start to slide. Basically, the frog was supposed to feel the heat. But guess what? None of that really happened. The economy just kept chugging along, and the frog? Still chilling. And that's a big reason why the Fed held off on cutting rates until September. They were waiting to see if the heat would actually kick in, and it just didn't. All right, let's dive into something super eye-catching in the U.S. economy. Among all the data out there, one thing really stands out: corporate profits. In 2024, U.S. corporate profits grew by a solid 7.7%. And here's the kicker. Profit margins for U.S. companies hit their highest level in 70 years. In plain English, post-pandemic, American companies have been making money like it's the post-whoosh boom all over again. BlackRock actually did a comparison of profit margins across US, European, and Asian, excluding Japan companies over the past 20 years. The trends started to diverge sharply after 2008. Before that, a big part of why US companies were raking it in was thanks to the internet boom. But that's not the focus here. What I really want to highlight is this. After the pandemic, corporate profit margins in both the US and Europe have gone up. Why? One major reason boils down to inflation. Think about it. Back in the days of ultra-low inflation and near-zero interest rates, prices stayed pretty stable. A bubble tea that cost $5? It was always $5. As a consumer, you knew it should be $5, and businesses couldn't just raise prices easily without pushback. So what happened? Companies were often forced to squeeze their own profit margins instead of hiking prices. Fast forward to the last couple of years and inflation's changed the game. Prices aren't just stable anymore, they're moving. Now it's less about if prices go up and more about how much they go up. Consumers? They're not sure what things are supposed to cost anymore. That mental price anchor, it's gone. And companies have taken advantage of this uncertainty, nudging prices up just a little more to boost profit margins. In a way, you could say businesses are capitalizing on a bit of consumer confusion. Or to put it bluntly, they've found a way to get a little extra out of your wallet without you noticing too much. But here's the thing. When you zoom out and look at the economy as a whole, these companies don't just hoard all the extra money they're making. They reinvest it back into the economy, speeding up its overall growth. That's actually one of the reasons why many economists argue that some level of inflation is necessary to keep the system running. But we're not done yet. You know what happens when corporate profit margins go up? It widens the wealth gap in the US. Here's why. That extra profit isn't evenly spread across all businesses. Nope. It's getting more and more concentrated in the hands of the biggest companies. So much so that you could say the US economy is becoming increasingly tied to these mega corporations. Just look at this. 10 years ago, the top 10 companies in the S&P 500 accounted for 18% of its total value. Fast forward to now, and that number has doubled to 36%. That's just 10 companies making up over a third of one of the world's most important stock indices. Even scarier, 3 companies, Apple, Nvidia, and Microsoft alone account for 20%. Yeah, just 3. Over the past 5 years, the wealth gap has widened not only between CEOs and workers, but also between big corporations and small businesses. And that's why, even though U.S. economic data looks great on paper, many Americans aren't feeling it. In fact, for a lot of people, life feels tougher than it did a few years ago. Look at what's happening. Mass layoffs in Silicon Valley, Wall Street, and even Hollywood. The reality is that wealth is becoming more and more concentrated at the very top, probably in the hands of the top 0.01%. It's like the economy's winning, but the average person, not so much. All right, now let's talk about U.S. monetary policy. We all know the Fed's decisions move the dollar. And the dollar, well, it moves global financial markets. That's why everyone's got their eyes glued to the Fed and every move Jerome Powell makes. But what's Powell watching? His focus is mainly on 2 things: inflation and unemployment. Here's the situation right now. Inflation has settled into a pretty stable range. It's not exactly front-page news anymore. People are starting to put it behind them. So the Fed's attention has shifted to unemployment. In November, the unemployment rate was 4.2%. The general thinking is, as long as it stays below 4.5%, it's not likely to disrupt the Fed's plans for rate cuts. But here's the thing about this round of rate cuts. It's probably not going to cause the same massive waves in global markets as the rate hikes did 2 years ago. Why? First off, those hikes came fast and furious, catching the market completely off guard. And the magnitude, wild. The Fed went from near zero rates all the way to 5.5%, hiking over 500 basis points in record time. Now with this rate cutting cycle, things are way calmer. They've already brought rates down to 4.75%, and most people expect the final destination to be around 3.5%. Here's the kicker. We're probably not going back to the days of 2% or even zero rates. There's just not that much room left. Maybe another 100 basis points to cut. And that's about it. Makes sense, right? All right, let's talk about what we might expect in Trump 2.0. His policies will likely focus on a few key areas: tax cuts, deregulation, trade protectionism, and tighter immigration controls. So what does this mean for the U.S. economy? On the upside, these policies could stimulate overall economic growth and demand, encourage capital to flow back into the U.S., and strengthen the dollar and stock market. Sectors like traditional energy, financials, and even Bitcoin might see big gains. Speaking of Bitcoin, remember that one snowstorm during Trump's campaign? Boom! Bitcoin shot up from $70,000 to $100,000. Why? Many speculated it was tied to expectations that Trump's regulatory stance could be crypto-friendly. But let's not ignore the potential downsides. For one, there's the risk of inflation. Policies like trade protectionism and tighter immigration controls could reignite inflationary pressures. Now Trump says he has a plan to combat this by increasing oil supply to stabilize prices. But based on market reactions, people are still a bit skeptical. After Trump's win, federal funds rate futures prices fell, reflecting concerns that a resurgence of inflation could slow down the Fed's rate cuts, push expected rates higher, and bring down futures prices. Then there's the issue of uncertainty. Trade and immigration policies, for example, could introduce more unpredictability into the U.S. economy. If Trump brings back tariffs, other countries aren't just going to sit there, they'll respond. And how they respond? Well, that's the wild card. That said, when it comes to U.S.-China tariffs, the uncertainty is relatively limited. Why? Both sides, including businesses in the U.S., have had years to prepare for this scenario, not just mentally but operationally. This time is nothing like the first trade war. Back then, China made up 20% of U.S. imports. Now it's down to 13%. Both sides are more or less ready for a breakup. Actually, breakup might not be the right term. With global supply chains so deeply intertwined, a complete decoupling isn't realistic. Take this Harvard Business School paper, for example. It analyzed the situation and found that many goods that used to come directly from China to the U.S. are now taking a detour through countries like Mexico or Vietnam before reaching the U.S. So it's not total deglobalization. It's what we call the Great Reallocation. And the biggest winners of this reallocation? Yep, likely Mexico and Vietnam. Looking ahead to 2025, most analysts think the U.S. economy won't be as strong as it was in the past 2 years. The IMF predicts GDP growth will slow down to around 2.2%. Over the past couple of years, though, that risk has been gradually fading away or disappearing altogether. What was this risk? Commercial real estate in the U.S. Now, don't get me wrong, it's not like the risk has totally vanished, so let me explain a bit. What exactly is the commercial real estate crisis? Here's an example. There's a building in New York called 1407 Broadway. It's an office building. Normally, a building like this would issue bonds to raise money and leverage more debt. Back in 2019, it issued $350 million in bonds, and because it was right in the heart of Manhattan, it wasn't worried about leasing the space out. It was practically guaranteed. So those bonds were rated AAA, basically the highest rating, even better than U.S. government bonds. But then came the pandemic. Suddenly, no one was renting the space, and by June 2024, they had to tell everyone, sorry, we can't pay default. Now, AAA-rated bonds have a default probability of less than 1 in 1,000. But guess what? The investors in 1407 Broadway got caught up in this. And here's the thing. This wasn't just an isolated incident. Most commercial real estate bonds have some degree of this risk. So the whole CMBS, commercial mortgage-backed securities, market got thrown into chaos. The hardest hit group, some of the smaller regional banks in the U.S., over $1 trillion in commercial real estate loans and bonds are held by these smaller banks. If these smaller banks start to collapse, it could trigger something similar to the Silicon Valley Bank disaster. That was the big worry for the U.S. economy, a potential time bomb waiting to explode. But as time passes, while the risk hasn't fully disappeared, the chances of it triggering a full-blown economic chain reaction have significantly decreased. Why? Because the banks have made it through to the Fed's rate cuts. As those cuts start to kick in, The investment market will gradually heat up again, and the chances of a massive banking collapse, much less likely, especially during this Fed rate cutting cycle. If you ask me the biggest potential crisis facing the US right now, it's got to be the national debt. This constant, slow creep of borrowing, that's the real frog in boiling water situation. Think about it. Congress can't seem to go a week without fighting over something. There's always some urgent issue that requires a bigger budget, more spending, or another debt ceiling increase. So the water just keeps heating up, bit by bit, and the frog inside is thinking, oh, this feels kind of cozy. Now, to be fair, in the short term, this probably isn't going to lead to any major catastrophes. But still, it's worth keeping an eye on, right? All right, so that's my breakdown of some of the key points about the U.S. economy right now. In the next episode, I will continue to bring you an economic overview of Japan, China, Germany, and other countries in 2024. Please subscribe to my channel and like the video to ensure you don't miss the exciting content in the next episode. Your support means the world to me.